My favorite option trading strategy is called the wheel strategy. The wheel strategy is a system of selling cash secured puts until you're assigned long shares of stock, and then turning around and selling covered calls until those long shares of stock are assigned and called away. And then you restart the wheel again by once again selling cash secured puts. Now the wheel strategy, it's great, right? The wheel strategy is fantastic, but as I've grown and developed as an option trader over the years, I couldn't help but feel that there was something missing with the traditional wheel strategy. It just wasn't as powerful or as flexible as it needed to be. This led me to develop the super wheel strategy. I wrote a book entitled The Super Wheel Option Strategy that's available on Amazon. You can find a link in the description below. But what the super wheel strategy is, it's a better way, a more flexible way of running the wheel because you have more option strategies to choose from in order to start the wheel strategy. Today, I'm going to give a quick overview of the super wheel option strategy. So let's discuss the super wheel strategy. This is taking the traditional wheel strategy to another level. So the standard wheel strategy is basically what I described earlier. You sell a cash secured put or multiple cash secured puts until you are assigned 100 shares per contract of long stock. And then once you have the stock, you sell covered calls against your new long stock position until the covered calls get assigned and those shares are called away. And then you're back at the beginning of the wheel selling more cash secured puts. Now, the standard wheel strategy is very easy to understand, even for novice options traders. You know, the wheel, this diagram explains it rather simplistically. This is not a hard strategy to learn, but there is a problem with the wheel strategy, at least in my opinion. The traditional wheel strategy, by only employing those cash secured puts and those covered calls, well, they're very similar as far as their risk profile because both cash secured puts and covered calls, those two option strategies are very similar as far as directional risk because both of them are bullish strategies. And if you look at the risk profile for both, they are almost exactly the same as far as risk profile. If I go to this next slide, I've shown this slide on a previous video when we were discussing the standard wheel. This is the risk profile for a short put. And you can see you've got unlimited risk to the downside, and then you've capped your upside risk here, right? And if you look at the risk profile for a covered call, it's essentially the same, right? They are very, very similar strategies. So they're both rather bullish strategies. And because the standard wheel strategy is a combination of two bullish strategies, you really run the risk of getting too bullish in your overall portfolio if all you ever do is trade cash secured puts and covered calls, because your portfolio is going to have all of this long delta. You're going to be very long delta, which means you're very long the market. So when the market has a drop, when it has a drawdown, maybe a significant drawdown, what's going to happen to your account? Well, your account is going to take a huge drawdown as well, right? You're going to lose a significant percentage of your trading account because you're just too long. And this really was the genesis of the super wheel strategy because I wanted to incorporate some bearish and or neutral strategies alongside those bullish strategies, because if all you ever put on are those bullish strategies, you're just going to get way too long. So I like incorporating occasionally, some bearish strategies, some neutral strategies. So that gives us a lot more flexibility in our trading. Because of that increased flexibility, that's why I have called this system the super wheel strategy. So let's talk about how my super wheel strategy developed. So obviously I started using the standard wheel strategy, which is starting by selling a put. You sell a cash secured put, a standard short put, right? And if that put goes against you, you finally get assigned long shares of stock. And then once you're assigned long shares of stock, you do a covered call because you already own the shares, so you sell a call against those shares. And if you're assigned on the call, that means you're supposed to sell 100 shares. Well, you've already got 100 long shares, so essentially your shares just get called away, and then you start the wheel again by selling a put. But it all started, the super wheel started was I didn't really care for the covered call. I mean, the covered call's all right, but a lot of times when I got to this part of the wheel, the back half of the wheel, instead of just doing a covered call, I didn't want to just get call option premium by selling a call. I also wanted to sell a put. I wanted to sell a put and a call to get double the premium, because it's all about collecting option premium. So what I was doing is I was selling a covered strangle. So I was combining a cash secured put and a covered call, because a cash secured put, you got money on the side to cover the assignment of the put, and then on the covered call, you're already long 100 shares to cover the assignment on the short calls. So the covered strangle was really how the super wheel began, because I love this covered strangle strategy, mainly because it's just better as far as it's double the option premium. Now, the problem with the covered strangle is it's bullish. So we already have two bullish strategies, the cash secured put and the covered call, and the covered strangle is also a bullish strategy because it's a combination of those two strategies. So it really makes the covered strangle a very bullish strategy if you really think about it. So honestly, you should only use the covered strangle if you still need more long deltas, if you still want to get more long the market. The other thing you need to be careful with the covered strangle is you could end up being assigned more shares. You already have 100 shares. If the put gets assigned, well, now you have 200 long shares, and then maybe you do another covered strangle and that put gets assigned. Now you're 300 long shares. You can get way too big really quickly here. So make sure only use the covered strangle if your position size is already small enough that you're fine if you get assigned again. If you can accept assignment of more shares, then the covered strangle is great. If you really don't want to have more shares, do not do the covered strangle. Just stick with the traditional covered call. Now, over time, as I placed more and more of these covered strangle trades, it got to the point where there was one issue I had with the covered strangle. It's a great strategy, but the one issue I had with it, I hated having 100 shares of long stock, because that takes a lot of buying power, because shares of stock are expensive. Options in comparison are very cheap. I can just sell a strangle without having those shares, and it drastically reduces my buying power. So the next kind of tweak that I did for the super wheel strategy was I just got rid of the shares altogether, and I started incorporating occasionally some short strangles, just your plain Jane naked short strangle. So I'm not carrying those shares of stock anymore. And what this really helped me do is now I'm much more diversified as far as direction, because a strangle, unlike the covered strangle or the covered call or the cash secured put, the short strangle is not a bullish trade. It is directionally neutral, meaning you win if the stock doesn't move very much. Now, you can lose if the stock drops or if it rises in price, so that's the downside. Now, on the put, if you're running the wheel, you're not really concerned about the downside, because if your put finishes in the money, you can always accept assignment. So you take your shares and then you proceed to sell covered calls or covered strangles, whatever you want to do at that point. So really, if you're running the wheel, the only side of a short strangle you're really concerned about is the call, because the call can go against you, and it can go against you in a big way if you're trading short strangles on the wrong kind of underlying. You don't want an underlying that has the potential to explode in price. So you would never want to sell a naked strangle, for example, on a meme stock. You remember like the meme stock craze from a few years ago with GameStop and AMC and things like that. Some of those stocks would sometimes have 1,000% increases in a day. And if you did that with a naked short call strategy like the short strangle, you would blow up your account. So be very careful on the kind of underlyings that you sell a naked short strangle. But again, the great thing about these strangles is just for directional purposes, if you don't want to add any more long deltas, you can sell all the strangles you want, and you're not going to add or decrease your deltas. Your deltas really shouldn't change as long as you're putting on these directionally neutral short strangles. Now, the more strangles I sold, the next evolution of the super wheel strategy was I really grew to hate naked calls. Naked short calls are dangerous, right? I've already mentioned that the real problem with a strangle is the upside, this call. Well, you know what? You can actually cap that upside risk by turning that strangle into a jade lizard. And that was kind of the next evolution of the super wheel, is why don't I begin the wheel strategy by selling a jade lizard? Now, a jade lizard is essentially a strangle, except you buy an out of the money long call to cap your upside risk, so you no longer have that unlimited risk to the upside. As far as directional risk, the Jade Lizard is neutral to slightly bullish. Again, you can think of it as a short strangle with that out of the money long call to cap your upside risk. We have no upside risk if we place the trade correctly. You can also think of the Jade Lizard as an iron condor, but missing the long put that you would have as part of an iron condor. You can also think of this as a short put plus a call credit spread. Now, I mentioned that we have this upside risk that is capped, and we will not lose money on the upside as long as we collect a total credit that is greater than the width of the call spread. So if the call spread is a $5 spread, a difference in their strike prices, as long as I collect a credit more than the call spread, the width of the call spread, then we're actually going to be profitable even if we lose on the upside, right? Because we can't lose to the upside at that point. All we really have to worry about with the Jade Lizard is the short put. And again, if we're running the wheel, we've already decided what to do with the short put. We will accept assignment of shares if that short put finishes in the money. So in a lot of ways, the Jade Lizard makes total sense to start the wheel. Well, you can't lose to the upside, and on the downside, well, you're already fine with accepting the shares anyways, so the Jade Lizard is just a fantastic way to start the wheel. Now, as far as volatility, all of these strategies, whether it be the cash secured put, the short strangle, the Jade Lizard, all the strategies that are a part of the super wheel strategy are short option strategies, meaning primarily we're selling options rather than buying them. Because of that, you would prefer to trade these on underlyings that have high IVR, high IV rank. So that is something to keep in mind. Now let's proceed with the evolution of my super wheel strategy. As much as I really loved the Jade Lizard when I first started trading it, I quickly discovered a very similar strategy that has a very similar risk profile to the Jade Lizard, but I actually thought that this was an even better way to start the wheel. This is called the put ratio spread. So this is a short put ratio spread, and you can see very similar to the Jade Lizard. There is no upside risk. There is downside risk, but the downside risk, if we're running the wheel, we're going to accept assignment of shares. So if I go back to the Jade Lizard, so this is the Jade Lizard. It kind of looks like a lizard, right? You got the body, you've got the tail. The put ratio spread is very similar, except instead of having that flat plateau, we have a tent in the middle of the risk profile. That is really the only difference between the two. Now, the short put ratio spread, what this is the sale of 2 or more puts at a lower strike and the purchase of fewer puts at a higher strike. Typically, you'll do this at a 2-to-1 ratio, but you can make the ratio anything you want. But, typically most people are probably going to put on a 2-to-1 short put ratio spread where you sell 2 puts and then you buy a higher strike put. And very similar to the Jade Lizard, you have no upside risk as long as you put on the trade correctly. So when you're picking your strikes, you need to make sure that you are collecting enough credit to where this line here is above, it gives you a credit, because if this line is below, if it was down here, then you're actually going to have a small loss if you lose to the upside. We want to have a small gain if we lose to the upside. So, if the stock just goes up and up and up, we're going to get a little money, right? It's not going to be a big winner, but at least we don't lose. That's why we're capping the upside. The downside, we're a little less concerned about, because honestly, if we lose on the downside, we've got one naked put that we're going to accept assignment of shares. And the reason we only have one naked put is because the other put is part of the put debit spread is what this is. It's a put spread. They take care of themselves. And honestly, if you lose to the downside, the put debit spread is a winner. You're going to take that thing off for a winner. You're going to actually make money on the spread. And the one remaining short put, you're going to just accept assignment of the shares and then proceed to the back half of the wheel, selling a covered call, for example. Now, the next evolution for the super wheel strategy is really, this is the only strategy that doesn't involve a short put, and it's not really running the wheel necessarily, but occasionally you may want to sell some naked calls instead of covered calls. Occasionally, you may just want to put on plain short call trades if you're somebody running the wheel, because if you're running the wheel, you're putting on so many bullish trades. Even the neutral strategies like the short strangle, the Jade Lizard's kind of neutral, the short put ratio spread is kind of neutral, slightly bullish maybe, but you end up being very long the market running the wheel. And sometimes you really want to reduce your deltas. And the only way to really reduce your deltas in a dramatic way is to just sell some calls, sell some naked calls to get that delta number down so you're not so directionally long the market. That way, if the market crashes, you've got some short calls and some positions that could potentially help offset those losses if the market has a drawdown. Now, of all the strategies that we've discussed being part of my super wheel strategy, the naked call is by far the most dangerous because, again, any underlying stock that has the potential to explode to the upside can really hurt you. So do not sell naked calls on meme stocks. Don't sell naked calls on underlying stocks that tend to be very volatile. Like, I wouldn't sell a naked call on something that really moves around. Something like Tesla, for example. That's a very large, popular stock. A lot of people trade. Tesla really moves around. I'd sell calls on things that are boring, maybe financial stocks or utility stocks, things that aren't likely to really make a move that's going to, I'm going to wake up one day and the stock jumped up 10%. I don't want to trade naked calls on an underlying that has that kind of potential. Now, if you begin selling naked calls, you've already gotten kind of used to how calls work. Anyway, you've been doing covered calls. Now, a naked call, essentially your covered call, except you don't have that safety net. So now what you need to do is, if the naked call you're selling goes against you, you have to do something about it because you don't have that safety net of the shares. So what do you do if the naked call goes against you? Well, if that call hasn't been breached yet, you could always just go ahead and buy the shares needed to cover it. As long as you get there before the underlying has moved above the call, you can buy the shares to cover it. You could also sell a put to create a strangle. So as the underlying stock moves against that call, sell a put to create a strangle. And then, that helps offset some of the loss that you're going to incur, unless, of course, that stock falls back down in price, which hopefully it will, but you never know. You're going to have to play a little bit. You're going to have to do something. You can't just let a naked call go unmanaged, right? Obviously, you can always roll out in time to give yourself more time to be right. You can also roll out in time and up in strike price, to give that call a little extra runway, a little extra cushion. But naked calls are definitely dangerous. And if you're brand new to options trading, I suggest not trading naked calls until you have considerable experience, because again, this is definitely a little more dangerous than a lot of the other strategies I've shown today. So that is a quick overview of my super wheel option strategy. Check out my book, The Super Wheel Option Strategy, for a more in-depth look. Again, the link is in the description. The book is available on Amazon. The Super Wheel Option Strategy, it's basically just your traditional wheel strategy, except it has more tools in the tool bag, right? Because the traditional wheel, it only has the 2 tools in the bag. It has cash secured puts and covered calls. And I like having more tools available. So I do cash secured puts, covered calls. I do the covered strangle, the naked strangle, the jade lizard, the put ratio spread, and sometimes I'll even throw in naked calls just to have more options available. No pun intended. Peace, guys.